One more, and then they're done? What does it look like to you? Does it matter?
The next move might be up. And if it is, it's going to be small, right? But the next big move, and by big I'm talking about the next 50 to 100 basis points of move, is probably down, and that's a bit how the market is priced right now. That's why it's not wrong to be looking through the next policy meeting. Markets are like that. Also, late cycle behaviour tends to be associated with a bifurcation of views. So you'll get people on this set telling you everything, right? Every range of views, and none of them are wrong.
They all could be right.
They all just a case of time horizon. That's the question. So, look, it is quite exciting with all these meetings this week, but don't get your expectations up. You might be disappointed. It could be that there's very little. Imagine if we get through the week and there's nothing from anyone. I mean, that's not impossible, right? So no hike, no cut, no tweak, nothing. That might well be what we get. And actually, this is late cycle behaviour. We're at the top within 25 bips or so. I think that the bond market made its case back in last October when in the US at least 10-year yields peaked, and we're 50 basis points below. Just think about how impressive this is. The 10-year yield is 50 basis points lower than that point in October, but the Fed has hiked 200 basis points. They did 175 during that period, a 50, and then there was 325s.
Yeah.
Right. So now if they move to a skip or whatever, it's just that the pattern is quite consistent. So the market priced it in because back in last October there was a lot going on. Yeah. China was opening up. Inflation was high. Fed was hawkish. The UK just had a bit of an accident the month before. So
where do you think yields? So we've established, to your point, that yields have peaked. They didn't peak this year. They peaked last year.
Yeah.
So if you had to be anywhere along the curve right now, where would that be? And what will be the trigger for a very substantial rally on the 2 years?
Yeah. Just to qualify that point, David, the 10-year and the 30-year clearly peaked last October. It's very difficult to imagine getting above 4 for the 10-year. The 2s and the 5s have been flirting with the peak a few times because they're much more policy sensitive. Yeah. So this is a really key question. When do you buy 2s? They're at 4.6 now. So clearly at 4.6 they're comfortably below the money rate. The money rate is 5 to 5.25. That means the market must be pricing in some kind of turn. Our view is that the rate cuts don't come till next year, but the question is, does something happen to make the market even more certain that they're coming? Now, if the market is tipping towards hard landing versus soft, and actually it's all about probabilities, at the moment most people agree there's going to be a slowdown of some sort, but if you tip towards a hard landing, some kind of event, or the data starts to really soften, then the market's quite capable of pricing 100 basis points in a single meeting in 2024, and if that was ever delivered, the market would price at 100 at the next meeting. And it's all about probabilities. I'm not saying that's going to happen, but that's why it's possible for the 2s to sit at 4.6 when the money rate is above 5. It's not wrong, right? It's just pricing in the turn. Yeah. I suspect it's difficult for 2-year yields to go up very much from here as well, to tell you the truth. So there's something for everyone, I think. If you're a retail investor and you're cautious, you've got bills, you've got credit that yields 5. You can, if you need some kind of hedge against equities, you can go into the 10-year at these levels. There's something for everyone.